What do you think will drive Tesla stock to soar? Tesla stock has been undeniably performing poorly in the past year, and it appears like it is going to continue doing so. Still, there are some who remain optimistic about the leading EV company's future. You would not want to miss this. James Stevenson, a Tesla shareholder known to be a Tesla analyst as well as a prominent Tesla Twitter community member, recently shared quite a lengthy Twitter thread reflecting his positive outlook for Tesla in 2023. In a January 16 tweet, Stevenson said, "Haters might guess that Tesla's recent deep price cuts would wreck any prospects for 2023 earnings growth. I hate to disappoint them, but record quarterly deliveries and earnings are still coming in 2023. He then followed up with a series of tweets in a Twitter thread providing graphs and explanations about his view. According to him, while Q3 and Q4 deliveries both missed analyst expectations due to Tesla's winding down the wave of deliveries, the recent price cuts ensure that Tesla's S3XY deliveries will continue setting new quarterly records. Stevenson claimed that Tesla makes the two best-selling luxury vehicles in the world, which are the Tesla Model 3 and Model Y. He added that Model 3 sales are still growing, although not as much as Model Y, which is ramping up production past 3,000 vehicles per week at both of Tesla's newly opened factories in 2022. The Austin and Berlin plants have significantly ramped up production since they started operational capacity. In a subsequent tweet, Stevenson presented a chart that illustrates production and delivery numbers. Pertaining to the said chart, Stevenson explained, "The solid red line production exceeds the dotted white line deliveries from mid-2022 through 2023 as ending inventory levels keep rising and average cost per vehicle delivered improves, better profitability." The Tesla analyst also said that earnings growth matters most to investors in terms of profitability. "My forecast assumes Tesla will grow earnings over the next several years by making full self-driving so compelling, more buyers will pay for it at higher prices before long," Stevenson said. Sometime in 2022, Tesla CEO Elon Musk forecasted that Tesla full self-driving could be released to qualified vehicles by the end of 2022. In a conference, Tesla's head of investor relations, Martin Vicha, noted that the company was on track to release supervised FSD within Musk's predicted timeline. Vicha explained that supervised FSD is basically supervised autonomy, meaning the driver is still an active participant in the car's mobility. When Tesla widely releases full self-driving at the end of the year, drivers must still pay attention to the road and follow proper driving practices. Vicha hinted that drivers who do not drive responsibly with FSD would lose access to the service, similar to how drivers in the FSD beta program lose access to their advanced driver assist systems when they drive irresponsibly. He added that Tesla collects more data from interventions, meaning the company learns more from drivers who actively correct full self-driving's movements. "We profoundly believe mass collection of data and AI is the only way to solve generalized autonomy. That's the path we're taking," Vicha said. Going back, in yet another chart in the previously mentioned Twitter thread, Stevenson presented his updated chart that shows where Tesla's average dollar of revenue comes from, as well as his forecast for 2022 Q4. "I'm forecasting Tesla Energy to see substantial revenue growth from Megapack XL as the new factory in Lathrop ramps up and 2023 incentives kick in. The Tesla Energy business has notably seen significant progress in 2022 amidst economic uncertainties that brought Tesla stock down. In light of this, Stevenson sees substantial revenue growth from the Tesla Megapack, which stores energy for the grid reliably and safely, eliminating the need for gas peaker plants and helping to avoid outages. According to Tesla, each unit can store over 3 megawatt-hours of energy, which is enough energy to power an average of 3,600 homes for an hour. During the Q3 earnings call in October, Tesla CEO Elon Musk said, "We actually see the energy storage business, stationary storage, growing more like 150 to 200% a year, much faster than cars by a lot." Tesla Energy is the company's energy division that installs solar panels, solar roofs, and stationary energy storage products like Powerwall and Megapacks. Energy storage deployment was at a record high of 2.1 gigawatt-hours in the past quarter. In its shareholders' letter, Tesla gave some details about the new record. Energy storage deployments increased by 62% year-over-year in Q3 to 2.1 gigawatt-hours, by far the highest level we have ever achieved. This level of growth was accomplished despite semiconductor challenges continuing to have a greater impact on our energy business than our automotive business. Demand for our storage products remains in excess of our ability to supply. We are in the process of ramping production at our dedicated 40 gigawatt-hour Megapack factory in Lathrop, California to address the growing demand. It appears that a ramp-up in Tesla Powerwalls and Megapacks is responsible for the new record. On energy profitability, we achieved our strongest gross profit yet for this business, driven primarily by record volumes of our Megapack and Powerwall products, said Tesla Chief Financial Officer Zachary Kirkhorn during the earnings call. Tesla's earnings per delivery are world-class for any automaker, let alone an EV maker, said Stevenson. According to him, Tesla's strategic price reductions will throw the brakes on earnings per delivery growth in 2023, but earnings dollars will rise because deliveries will rise. He further explained the reason why earnings per delivery aren't falling by more. He shared that the Berlin and Austin plants are ramping, which means lower costs per delivery. Also, the highest cost per vehicles are in Fremont, which is becoming a smaller portion of the global mix. The more vehicles you produce per week, the harder it gets to deliver all of them by the end of each quarter, Stevenson explained. In another chart, he illustrated how ending the wave affects Tesla's quarterly finished goods inventory level. Stevenson also noted that Tesla's automotive gross margin, excluding regulatory credits, improved throughout 2021 to 2022, even as revenue per vehicle decreased, which according to him is hard to do. He believes that while Q4 will present a fall, it should rise throughout 2023. In a more comprehensive chart, the Tesla analyst showed how Tesla's revenue has grown over time. I'm forecasting Q4 revenue at an all-time high over $25 billion, more than the full year 2019, he said in the tweet. Some Tesla believers like to claim that Tesla's operating expense numbers must be fraudulent because they aren't increasing by enough. That's mostly due to CEO stock comp, he said in another tweet. Q4 2021 in particular had a one-time $340 million payroll tax for Elon's 2012 stock comp exercise. The rest of the Twitter thread from Stevenson shows various charts of his forecast, as well as a series of more comprehensive illustrations of Tesla's deliveries, revenues, and earnings. On a different note, some analysts are convinced that Tesla stock is the best idea for 2023 after the worst year ever. In late December, Baird Equity Research's Ben Kallo cut his Tesla price target to $252, down from $316. Kallo then touted Tesla as a best idea stock for investors in 2023. Prior to that, 6 analysts cut price targets on Tesla shares. However, targets remain well above Tesla stock's current price level, and analysts have broadly maintained buy and outperform ratings. Kallo said investors should not be overly concerned with weakening demand early in 2023. The analyst wrote that Tesla has many demand levers to pull, including an increase in vehicle leasing and additional supercharging incentives. Kallo added Tesla is best positioned in the auto market as electric vehicles continue to take share of the total market. Baird's bullish view on Tesla stock follows Wedbush analyst Dan Ives, who also expressed optimism for the EV giant. Ives, a longtime Tesla bull, has recently and repeatedly expressed his concern with CEO Elon Musk. Since Musk took over Twitter, analysts have said the billionaire's tweets and the news cycle surrounding him are hurting Tesla investors. Musk has used Twitter to make political statements and interact with people across the political spectrum. Ives has called Musk's Twitter endeavor a soap opera and a fiasco that is causing brand deterioration for Musk and Tesla. Last week, Ives cut his Tesla stock price target to $175 from $250, keeping an outperform rating for the shares. Still, Ives remains optimistic. It would be easy for us and other bulls to throw in the towel here and view the near-term headwinds as too fierce to overcome for the stock to work in 2023, Ives wrote. The analyst added, if Musk refocuses on Tesla and stops selling Tesla shares, then this stock has bottomed in our opinion and works from here. Ives has notably pointed out that around 70% of the recent Tesla stock sell-off is due to the reaction to Musk and Twitter. However, any further Musk strategic missteps will be carefully scrutinized by the street and further weigh on shares, he wrote. Overall, Tesla stock remains to be a stock that needs to be watched, especially since we are still too early in the year to make any substantial predictions. Make sure to subscribe to this channel for more Tesla stock updates.